Good morning, everybody. This is Hugh Taylor, VP of Marketing at SOA Software, and welcome to the SOA University webinar series. Today's session is called SOX Compliance in the Age of SOA. Wanted to just give you a little bit of housekeeping stuff first. We're going to have question and answer at the end, but I'd also invite you to send questions during the presentation if you would like. The slides will be made available after the session if you want them. Please send me an email, and I will get them to you. My email address will be provided at the end. We're recording today's session, so we will make it available to you if you're not able to catch the whole presentation, or if you'd like to share it with someone else. We welcome you to pass it along. Just really quickly want to give you an overview of SOA Software. We are a venture-backed software company headquartered in Santa Monica, California, about 200 employees, very experienced team and partners and customers in the Fortune 500. We work with clients like Verizon, Merrill Lynch, Nissan, Staples, Sempra Energy, and others for development of enterprise service-oriented architectures. Partner with IBM, BEA, CA, Oracle, and others. I'll tell you a little bit about me, just so you know who you're on with. My background is in business management and the business side of technology. I've worked in enterprise software field, website development, also in the printing and entertainment industries. The reason I mention this is that my background, I want everyone to know that my background is diverse, and I've seen a lot of businesses run well and not well, and I have a feel for how things can go differently in reality than they are supposed to on paper, which is sometimes a relevant idea for Sarbanes-Oxley compliance. I'm the author of the book Understanding Enterprise SOA, which I wrote with our chairman, Eric Pullier, and my new book is called The Joy of SOX. And we're going to have a drawing at the end of this session to determine the winner of a free copy of Joy of SOX, which was just published by Wiley. Little preview of the session. We're going to go through 5 different areas in about the next 30 or 40 minutes before the Q&A. First, we're going to talk a little bit about what Sarbanes-Oxley is and why it's a critical and stressful issue for IT professionals today. I feel it's very important to establish a baseline of consensus of what the issues actually are before we get into section number 2, which is the impact of service-oriented architecture on Sarbanes-Oxley. We're then going to go into an example of a specific business with a specific architecture and how internal control is disrupted by the development of an SOA. And then we're going to look at solutions, and then we're going to look a little bit at SOA Software's solutions for these kind of challenges. So the question is, why is SOX a critical and stressful and complex issue for IT professionals today? And I think if you're on this webinar, you probably are experiencing some of the hassle and cost that can come up with Sarbanes-Oxley. This is a big issue for public companies today. Gartner estimates that almost up to 15% of IT budgets in 2006 are going into Sarbanes-Oxley related efforts, which is a huge amount of money. And almost more important, it's a very, very large drain on people's time. If you look at some of the figures from 2004, Viacom tested over 19,000 controls. Time Warner spent 350,000 person hours on financial and IT controls in 2004. This is a very, very significant amount of work. As one executive said in an interview, imagine Y2K every year. Someone else says, Bobby Russell from First American AG in a magazine article said, it's rare to have something literally fall from the sky that stops all the projects that we had on the table from an IT perspective. And then on the right, I just have a little graphic for fun. For those of you born before 1980, you might remember the old Marlboro campaign, Come to Where the Flavor Is. And for me, Sarbanes-Oxley has come to where the IT pain is. It is, as we have found, a major pain point for the people we work with in Fortune 500 and other public companies. Let's just say, what is SOX anyway? I found Sarbanes-Oxley is an area where Some people know about it. Some people think they know about it. Some people don't know what they don't know about it. And if you actually look at the wording of the law, and for our purposes, we're going to deal with Section 404 of the Sarbanes-Oxley Act. There are numerous sections of the Act, and they relate to a lot of different areas of corporate governance. But Section 404 is where the expense and time is found, and also it's one of the areas which most directly affects IT. This, if you read from the law, I'll just read an excerpt. It says, each annual report shall contain an assessment at the end of the most recent fiscal year of the issuer of the effectiveness of the internal control structure and procedures of the issuer for financial reporting. So as a real baseline understanding, we should all agree that Section 404 of the Sarbanes-Oxley Act relates to internal controls that relate to financial reporting. One of the biggest areas of misunderstanding with SOX, in my experience, is that people begin to take it into areas that don't cover financial reporting. So in the spirit of not looking for more aggravation than we need, let's just stick to financial reporting related controls. In English, what that really has come to mean is that CIOs and CTOs and people who work with them are responsible for the IT aspects of internal controls. And this includes areas such as segregation of roles in accounting. We're going to come back to that issue a lot more later. Correlation of data across systems for exception monitoring and account reconciliation. There are a lot of areas where IT is an underlying factor, often critical one, in supporting an accounting process that's an internal control over financial reporting. CTOs and CIOs are now becoming more involved in COBIT, which is a set of guidelines for IT governance, which has been recommended for use in Sarbanes-Oxley. So it's opening up CIOs and related professionals to a lot of new responsibility and areas of discipline that they may not have seen too much before, or at least not in the same level of criticality. What it means at the end of the day for Section 404 is that the management of a public company has to attest to the existence and effectiveness of internal controls. It's actually a three-step process. The company has to document and test the effectiveness of their internal controls and disclose any deficiencies. The top management of the company, usually the CEO and CFO, have to sign off and in a form letter that they file that the controls are effective. And then the company's external auditor must also come in and audit those internal controls and disclose if there are any deficiencies. So it's a cumbersome process, it's a big hassle, and it's very serious stuff because there are penalties for noncompliance, both criminal, civil, and intangible. You can have a situation where a disclosure of a deficient control or material weakness can affect a company's reputation or even its share price. What is an internal control? Internal control is a process effected by a company's board of directors and other personnel to provide reasonable assurance regarding the achievement of objectives in the following categories. And for us, it's reliability of financial reporting. Attainment of internal control is reliant on properly functioning IT in many cases. Internal controls involve integration of ERP and general ledger systems as just one example, and we'll get into a more detailed look at that in a little while. But there is IT present in many, many areas of internal control. In fact, Gartner recently stated an estimate that 97% of material weaknesses in internal controls could be remediated through IT. There are two types of internal controls. And if I'm going over stuff that you all know, please forgive me and just bear with me because I want to make sure that we're all on the same page with this. There are preventive controls, which are designed to prevent fraud and errors. An example of that would be a lock on a cash register. If you can't unlock the cash register, you can't steal money. You're preventing fraud or errors. A detective control is a process or reporting process that detects fraud or errors after a transaction is completed. And a simple example would be the cash register tape that people look at to see how many transactions have occurred and how much money should be in the drawer. So what does this have to do with IT? Today, many preventive controls are digital, such as passwords and user role settings. And many detective controls, such as audit logs or exception monitoring software packages, are based on IT. In both cases, both types of controls rely on an interplay between manual and IT controls. So if you're an IT professional, you're going to be involved. This quick example, this is not the main example, but this is just a quick example. A company might have an internal control that tries to provide assurance that the cost of goods expense is stated accurately in the period in which it occurred. You'll find a lot of internal controls over financial reporting relate to periods because earnings go in a periodic reporting basis. So companies want to provide assurance to investors in the markets that their financial reports are accurate in a specific period. So, in the SOX 404 process, the SOX auditor will want to see that the accounting processes and the IT systems that support them and the applications that support them are configured to make sure that, for example, if a company buys materials in the month of March, that expense will show up as an expense in the month of March and not in the month of April or February or July or whatever. And they're going to test that control. And when you're in IT, you have a lot to do with that. Accurate reporting of vendor expenses relies on proper governance of the systems involved in procurement. You might have a ERP system or a general ledger system or a warehouse management system involved in procurement. And they will all need to provide accurate information within the time period. You're also going to hear a lot about the COSO Framework. COSO is an acronym that stands for the Committee of Sponsoring Organizations of an entity called the Treadway Commission that was formed a number of years ago to look into establishing rules for corporate governance and internal controls. COSO was specified by the Public Company Accounting Oversight Board, the PCAOB, which is an organization that was created by the Sarbanes-Oxley Act to monitor the work of firms that audit public companies. And there's a lot written about COSO, and obviously I'm distilling this down quite a lot. But basically, COSO looks at internal controls as groupings of these three factors that come up in any given internal control situation. You'll have an internal control objective, which is represented in this little box here on the left. For example, to keep going with our example, company needs to be reasonably sure that its sourcing costs are booked into the period that they're supposed to be. Coupled with the control objective is a risk. And risk and control of risk and management of risk is one of the key concepts that you have to understand to get Sarbanes-Oxley compliance down properly. Company faces a risk of misstatement of financial results if sourcing costs are not booked in the correct period. If you're following the news with the trial of Ken Lay and Jeff Skilling, a lot of the trial is revolving around this type of issue. How much revenue and earnings was reported in a given period, and were the people involved guilty of manipulating those earnings? So that's the risk. To mitigate the risk and achieve the control objective, you have a control procedure. Now, there may be hundreds of these triple pairings in an internal control framework for a specific company. I'm just giving you one example. The control procedure might look something like this. To have an effective internal control for assuring that sourcing costs are booked in the correct period, the company needs to establish a proper cutoff procedure at the end of the month for all purchase orders. So in a paper-based system, there would be a cutoff after which you could no longer submit a paper copy of a purchase order to the accounting department to be booked into the period. The cutoff period and enforcement of that rule is the internal control procedure. In an electronic situation, that might be a setting on an application that precludes you from filing a purchase order after a specific date. But in order for the internal control to be effective, that has to be working right. In order for those to be working, the control objective relies on IT governance. Just to make things really confusing, it's worth noting that different people have different perspectives on Sarbanes-Oxley, and I'm not going to go into all of these things, but auditors and CPAs, lawyers, executive software developers, security people, and infrastructure people often have a quite different view on what Sarbanes-Oxley actually is and what it requires of them. And so this creates additional confusion. Now I want to stop and ask if there are any questions at this time, because I've just gone over a lot of material. You may already all know it, you may not. It's important to me to feel that you guys are understanding it, because if you don't, then the next 20 minutes or so is not going to make a lot of sense. So if there's any questions, please enter them into the little question box. There's a chat box in the a Q&A box in the lower right-hand corner of the screen. So please send me questions if you have them, and I'll answer them in real time. Okay. Well, I'm going to go back to the presentation, but please feel free to interrupt me. Service-oriented architecture's impact on Sarbanes-Oxley. Just really quickly want to establish what service-oriented architecture is. It's an emerging technology paradigm. It has to do with opening up applications to be able to interoperate with other applications using XML and web services and other open standards. It's at the heart of many new technologies being offered, such as Microsoft.NET, SAP NetWeaver, BEA Aqualogic, IBM WebSphere's new product suite, Oracle Fusion Middleware, and on and on. It is really the core offering of most major software companies in the world today, and it's very exciting because it offers a lot of potential to speed up software development and simplify application integration and increase productivity. But it also has the potential to disrupt internal controls and cause problems for Sarbanes-Oxley compliance. And in my opinion, these problems can be solved, but it's very important to have an awareness of what they are. Before we get started, I do want to make a point, though, because this is one of the biggest areas of confusion for people. SOA does not have a big impact on the IT general controls section of Sarbanes-Oxley. One of the things, when people in the IT community get involved in Sarbanes-Oxley, they're often involved in what are called the IT general controls, which are generally a set of